Hello everyone, and a very warm welcome to this ICAS webinar, the first of a two-part series of our spring tax updates. For those that don't know me, my name is David Mingus. I'm Director of Practice here at ICAS, and it's my great pleasure to be your webinar host today. In this series, we're going to be providing an essential roundup of the most recent tax developments. And while there hasn't been a formal fiscal event, as the government refers to it now, this hasn't, of course, stopped a raft of announcements being made alongside the spring statement delivered by the Chancellor at the end of March, and more recently, and indeed just earlier on this week, the Tax Administration Day. So in today's webinar, we're going to concentrate on recent tax developments across the main general taxes, and our second spring tax update webinar in 2 weeks' time on the 14th of May, we'll be looking at employment and owner-managed business taxes. But to take us through today's update, I'm delighted to be joined by my colleague Susan Cattell. Susan is our Head of Tax Policy here at ICAS. Susan is a Chartered Tax Advisor and joined ICAS after a varied career both with HMRC in practice and in professional education. She works closely with the ICAS Tax Board on the direction of ICAS tax policy and represents ICAS and our members on numerous HMRC forums. But before we begin, just a few housekeeping matters to remind you of. I do know that Susan has an awful lot to get through today, so unfortunately we won't have time in today's hour allotted to us to have a live Q&A section as part of the webinar, but you will still be able to submit your questions through a Q&A facility, which can still be accessed at the top of your screen, and we'll either respond directly to you after the webinar or include them in an anonymised Q&A document which will be published alongside the recording of this webinar. You can, of course, join the conversation through the chat box, which is accessed at the top of the screen, and this allows you to comment or discuss with fellow attendees various matters which are covered by this webinar. And of course, we are recording the webinar and we'll make it available for on-demand viewing afterwards in case you want to refer back to it. The slides will be available after the webinar as well, so you don't need to worry too much about jotting down your notes or anything like that. So as I say, I do know there's a huge amount to get through, so I'll just hand straight across to Susan to get straight into the detail of today's webinar. Susan, over to you.
Right. Good morning, everybody. Welcome to today's webinar. So let's just have a look at what we're going to cover today. I'm going to talk about some of the things that were announced in the spring statement, and also a few things from the unannounced and unexpected Tax Admin Day on Monday. We normally get told about them in advance, but this week we weren't, so it all came as a great surprise. And there were some good things in there which I'm going to pick up as we go through. I'm going to cover updates and developments across the main taxes. As David said, we haven't had a budget, obviously, a spring budget, but there are still quite a lot of things to talk about. I'm going to recap a few important things from the autumn budget, which have now been legislated in Finance Act 2025, and I'm also going to mention a few recent cases. I'm also going to mention there are a lot of tax consultations going on, and we're quite interested in getting feedback on those that can be sent to our tax mailbox, and you can find the tax mailbox address in any of my articles on the ICAS website. So I will be mentioning some of the consultations we're having a look at and we'd like your feedback on. What we won't be covering today is the topics that are going to be covered on the 14th of May in part 2, and that includes making tax digital for ITSA. So just in case you wonder why I'm not mentioning it today, that's why. Do sign up for the 14th of May. And we also won't be covering devolved taxes today, but just to note that the Scottish budget, there was a Scottish budget last December, and that was covered in the autumn tax update part 3 at the end of last year, and the recording for that's still available if you want to go and listen to it. So without further ado, let's get on with today's webinar. The government obviously committed to only having one fiscal event per year, so that's one budget, which is quite welcome because you can really do without having several big lots of announcements in a year. And we obviously had the first Labour budget for 14 years on 30th of October 2024. Now, there was some speculation that because of the financial situation, Rachel Reeves might actually have to make some tax announcements in the spring. But in fact, she didn't really make any significant tax announcements in the spring statement on the the 26th of March. She did, however, announce some additional funding and resources for HMRC on top of some additional resourcing that was already announced last autumn. And that's all very good news. And I'm going to pick up one of the areas later on in the presentation. There was also an important announcement about MTD ITSA, but I'm going to leave that for my colleagues to cover on the 14th. And there were numerous tax consultations. And then on Monday of this week, there were some additional announcements and consultations, and I'm going to pick some of those up as we go along. It seems that Labour are still committed to not increasing the rates of the 4 largest revenue-raising taxes. Rachel Reeves has sort of reiterated that fairly recently, and that does obviously leave some question marks about how she can raise revenues from taxes, because if you rule out increasing the rates of the 4 largest taxes, which is income tax, NICs, VAT and corporation tax, does rather limit your options. And of course, she did, in fact, increase employer NICs, which again will be picked up on the 14th of May. And obviously in the spring statement, she chose to announce some changes to the benefits rules rather than increasing tax. So we shall have to wait and see what happens in the autumn, whether she has to change her mind about that. So let's go and have a look at personal tax to start with. Now, I'm putting up virtually all of this slide in one go, because those of you who've been coming to the last 2 or 3 of these presentations will know immediately that it really hasn't changed. I'm not going to read out this slide line by line, because I'm sure you're all aware that the personal allowance and all these personal tax thresholds have been frozen for some time, and they're going to stay frozen for some time longer. And the one thing to note is that Rachel Reeves did say in her October budget last year that she does intend to start increasing those personal thresholds in line with inflation from April 2028. Now, it remains to be seen whether she's actually able to do that from April 2028, or whether she might have to change her mind, but that's certainly the intention at the moment. National insurance, again, you'll all be, those of you who come to these sessions will be familiar with this slide, because we had 2 rate cuts in national insurance from the previous Chancellor, a sort of present to his incoming Labour successor, if you like, because he cut the rates by 2% from 6th of January and 2% again from 6th of April 2024. So this is employees' national insurance. And that's quite significant, because Rachel Reeves had pledged not to increase it. Now, there has been a lot of speculation that she might have actually chosen to reverse at least the second of those reductions, but she hasn't actually done so far. So, although it must be a temptation, because, as I say, this is a big source of revenue, national insurance. And I'm not going to cover the self-employed NICs today, because they will be picked up on the 14th. Now, this is something that I think is quite important to be aware of. It was first announced in a rather chaotic way back in March, and it caused lots and lots of confusion. And then there was a bit more clarification and expansion on Monday. So I'm going to go through the correct details, if you like. The government is going to change the income tax self-assessment income reporting thresholds. Now, we don't know quite when. They've just said it's going to be within this Parliament. But what's really, really important to note is that the tax due is not going to change at all. What the government's not doing is changing the £1,000 tax-free allowance. And back in March, when this was first announced, you may have seen some of the stories that were saying, oh, the government's increasing the trading allowance, so and this will help people who've got side hustles and everything. But that's not what they're doing. It's really important to appreciate that. What's happening is the ITSA reporting threshold. So this is the threshold where you have to file a self-assessment tax return. Those thresholds are being aligned at £3,000 gross. And the way they're doing that is increasing the ITSA reporting threshold for gross trading income from 1,000 to 3,000, increasing the threshold for other taxable income or miscellaneous income from 2,500 to 3,000, and creating a single reporting threshold for property income at £3,000 gross. It's currently 2,500 profit or 10,000 gross income. And so all this means is that you might not have to file a self-assessment tax return if your income is above the £1,000 tax-free allowance but below 3,000. But you will still have to pay the tax on that income between 1,000 and 3,000. So 300 up to 300,000 customers will no longer have to file a return. But if they still have tax to pay, which many of them will, they can either stay in self-assessment until, of course, HMRC will probably try and throw them out if that's the only reason they're in self-assessment, or they will be able to report their liability through a new simple online service. Now, we don't have a timing for that new simple service. The announcement says that they're going to give a timeline when they publish HMRC's transformation roadmap later in the year. And obviously what we'd all like is for that simple online service to also allow people to report things like dividends, where they've got dividends over the dividend threshold. And other sort of small amounts of income that are taxable and need to be reported, but don't really justify filing a self-assessment tax return. So that's a wait and see, really. Right, moving on to dividends and savings. And again, I'm sure you'll get a great sense of deja vu on this slide, because the taxation rate for dividends has not changed. The rates remain exactly as they were last year for 2025-6. I won't read them all out to you. And the tax-free allowance for dividend income, it's reduced in the last few years from 2,000 right down to 500, which is why it's now become such an issue for people having dividends over that level and wanting to report them to HMRC. And I say, let's hope that this simple online reporting facility allows you to do that. So it's £500 for 2025-6. There's also been no change for the starting rate for savings. The starting rate limit or the starting rate, and no change to the personal savings allowance, which remains £500 or £1,000, depending on whether you're a basic rate taxpayer or a higher rate taxpayer. Just a word about ISAs. As you can see, the ISA subscription limit hasn't changed. It remains £20,000 for 25-26. There was lots of speculation that Rachel Reeves was going to cut it or in some way change it. She hasn't done so. The British ISA, which we were promised by the last government, which was going to be an ISA that you had to invest in British stocks and shares, that's been dropped. But there has still been speculation that Rachel Reeves might want to make some changes to ISAs, so just to encourage people to invest in stocks and shares rather than putting it in cash bank accounts. So it remains to be seen whether we might get some announcements on that later in the year. Right, I said I was going to talk about a few tax cases, which is good because we haven't really had time to do this in the last few of these updates. So this is quite an important case. I'm sure lots of you listening will remember when the statutory residence test was introduced in Finance Act 2013. And obviously took a lot of the difficulties out of determining residence, because it set out some objective tests rather than, everybody having to go and look at lots of old case law and work out what your subjective intentions were and everything else. So we have got the statutory residence test, and this is actually the first tax case to consider the statutory test. And it's really quite important because a key part of lots of aspects of the statutory residence test is how many days you're in the UK. So if we look at the case, it's an anonymised case for reasons that will become obvious. The taxpayer's 2015-16 return, she completed it on the basis that she was not resident, and that mattered because she had received a very large dividend in that tax year. Under the statutory residence test, the maximum number of days she could spend in the UK without becoming resident in the UK was 45. But she was in the UK at the end of the day on 50 days. So not surprisingly, HMRC argued that she was resident in the UK because clearly they wished to assess her on this dividend. And she claimed that exceptional circumstances prevented her from leaving. And this is an important part of the statutory residence test, because there is a provision that says, well, OK, you've been in the UK for 50 days in this case, but we can disregard some of those days if you're only in the UK for those days because exceptional circumstances beyond your control prevented you from leaving. And the legislation actually does say that exceptional circumstances might include something like sudden or life-threatening illness or injury. And the number of those days you can claim is capped at 60 in any given tax year. And obviously, when you've got these days, it has to be your intention that you will leave as soon as the exceptional circumstances allow you to do so. So what happened in this case was that the taxpayer's sister, she was an alcoholic, and her children were being put at risk, and she was at risk of suicide. And so the taxpayer in this case felt that she had to stay in the UK for those extra days to try and make sure that the proper care was put in place for her nieces, and obviously to look after her sister. So that's what she said, that of those 50 days, 5 or 6 of them were due to exceptional circumstances, and therefore she shouldn't be treated as resident. And the first tier tribunal found in favour of the taxpayer, and the upper tier tribunal, in a slightly odd decision which caused some comment, decided that it found in favour of HMRC, and they said that exceptional circumstances must be something that was physically or legally meant that your departure had been rendered impossible. And it could never be the case that sort of moral obligations, as you might feel to your alcoholic sister and your nieces, they don't count. That could never be an exceptional circumstance. They also said that death or severe illness was sufficiently commonplace for them not to count as exceptional, which is a bit odd given that the statute specifically refers to the possibility of life-threatening illness or injury being an exceptional circumstance. So luckily, the Court of Appeal, sorry, where have I got to? I shouldn't have clicked on. The Court of Appeal has now upheld the first tier tribunal decision and has provided some really helpful guidance on exceptional circumstances. And although they agreed with the upper tribunal that it's quite a high barrier, they disagreed that it was only where there were objective legal or practical obstacles that made your departure an impossibility. And they specifically said that they thought societal or moral obligations of the kind that applied in this case could mean that you had an exceptional circumstance. So really important first case, looking at what the meaning of exceptional circumstances is. Now, of course, we don't know if HMRC may try to appeal that. Capital gains tax. The CGT annual exempt amount, well, again, those of you who attend these sessions regularly will have seen this slide before. It was the annual exempt amount permanently fixed at £3,000 for 2205 and subsequent years, and it's £1,500 for most trustees. And obviously permanent is only permanent until a later chancellor decides that it's not permanent, but in this instance it hasn't changed since last year, so it's still the same for 25/6. What has changed though is that there were a lot of rate changes some rate changes announced in the autumn budget, and these have now been enacted in Finance Act 2025. So I'm just going to give a quick recap, because obviously if you're starting to fill in self-assessment tax returns, this will be highly relevant. First up, really important to note in this first category, so this is capital gains tax rates on assets other than residential property and carried interest. And for the first time since 2010, we actually have a split year. So we've got one rate applicable to the 29th of October 2024, which is 10% if you're a basic rate taxpayer, 20% for higher rate taxpayers. And then from 30th of October, so that's obviously because of the budget, we have an 18% rate and a 24% rate. And for 2025/6, we've also got 18% and 24% rates. And the rates for gains for residential property, and obviously if it's a disposal of a residential property that isn't eligible for private residence release, you have to report and pay the tax within 60 days. And the rates there didn't change. They've remained at 18 and 24% throughout. I'm not going to read out all the trustee rates, but they are on the slide, obviously. Right. Rates for individuals for gains on carried interest. Carried interest is the profits of private equity funds paid to individuals. It's long been argued that in some quarters that should really be treated as income, not capital at all. And that was certainly a Labour manifesto pledge that they would change this. But what they've done in the meantime is increased the capital gains tax rates. So we didn't have a split year for this. So for 24 to 25, the rates at 18% or 28%, depending on whether you're a basic rate taxpayer or a higher rate taxpayer. But for 25/6, the rates are 32%. And it's obviously really important to note that from April 2026, carried interest will be moved into the income tax framework, and there are going to be some special rules for that. So that's something to look out for if you deal with any private equity individuals. And lastly, business asset disposal relief and investors relief. Obviously, these were used to give you a beneficial tax rate of 10%. They will still give you a beneficial tax rate, but for 25/6, that was increased to 14%. And for April 26 onwards, it's increased to 18%. There was no change to the lifetime limit for business asset disposal relief, but for investors relief, the lifetime limit was reduced to 1 million from 10 million from 30th of October 2024. I'm not going to talk about anti-forestalling because that's largely now something that's in the past, but be aware there were anti-forestalling measures throughout. Right, let's have a look at inheritance tax. And this is just really an update on where we are since October. In the budget, we've had a long-standing freeze of both the nil rate band and the residential nil rate band, and none of that's changed. The nil rate band continues to be 325,000, which is where it's been since 2009-10, and the residential nil rate band is also not changing. And the previous government had said they would stay frozen until 27/8. And now what's happened is that the current government in the Finance Act 2025 has extended those freezers for a further 2 years until 5th of April 2030. Now, the result of that, and of course the other inheritance tax changes, is that we are going to get an increase in inheritance tax receipts. And in fact, we've already seen that because we do now have the figures to March 2025, and the inheritance tax has hit its highest annual receipts on record at 8.2 billion. And as you can see, the OBR is predicting that by 29/30, receipts will rise to 14.3 billion. So that's quite a big increase from 2.2. And 2.5 billion of that is due to the policies announced in October 2024. So let's have a look at those other announcements and see what's happened to them. The second change was APR and BPR. The cap on a cap on the 100% relief has been introduced for deaths or gifts from 6th of April 26 onwards. So you still get your 100% rate of relief for the first million of combined APR and BPR property, but above 1 million, you only get 50%. And the rate's also going to be 50% for AIM shares. So that's a really significant change. Now, we still don't have any draft legislation on any of this, so I'm not going to try and say anything more about the detail. There was a technical consultation that ran until April 2025 about how this would all work for trusts. And we had a discussion about this with our private client committee, and we took some input to a stakeholder meeting with HMRC. And it's fair to say that quite a lot of concerns were raised at that meeting. One of the key points that's being raised with HMRC is that this £1 million allowance, if you like, it's not transferable between spouses and civil partners. Now, there's absolutely no sign that the government's going to move on that, but it's very obviously out of line with the other key features of IHT, like the NRB or the residential nil rate band. And it clearly there could be perceived to be some unfairness where the first spouse has already died and it's too late, to use that allowance, if you like. So that's just something to flag. But as I say, there's no reason to think government's going to change it. But do watch out for the draft legislation, which we're hoping will come out soon, because it's making it difficult to advise clients when you don't even have draft legislation. The third change was, I'm sure you've all seen this, unused pension funds will be brought within IHT from 6th of April 2027. Pension scheme administrators will become liable for reporting and paying any inheritance tax due. And that means that they're going to have to liaise very closely with personal representatives, executors, And there's been a technical consultation on this one as well. Again, we don't have any draft legislation, but there has been a technical consultation on how this might all work. That ran until January. And again, we gave some input to HMRC at a stakeholder meeting, and a huge number of concerns were raised about the potential impact of the proposals on, how you actually administer an estate, and potential delays in distributing assets to beneficiaries. And also difficulties potentially getting people to be willing to act as executors or personal representatives. So watch this space on that one, because we don't have any draft legislation. We don't know exactly what's going to happen. Right, something else I wanted to mention. This is a piece of good news. I said at the beginning HMRC is being given more resources, and they have been given 52 million to pay to digitalise the IHT service, which I know is something that people dealing with HMRC really want to see. It was very helpful briefly during the pandemic when people were able to send things using Dropbox, but that had to be stopped because of security concerns. But they are now going to digitalise the system, and what's new is that HMRC are currently looking to engage with professional bodies, people working in inheritance tax, about what that digitalisation should look like. So if anybody's interested, has feedback to give, you can drop us an email to the tax mailbox, which I mentioned earlier, and don't worry, it appears on one of the latest slides. It's also in any of my articles on the website. So if you're interested, do let us know, because we have a representative on a working group, and also I'm the ICAS representative at a couple of inheritance tax and trust forums, and there's going to be an opportunity to give input there. So do let us know if you have any thoughts on what they should do with digitalising that service. And this is just a reminder, they extended the scope of APR to environmental land management from 6th of April 25, and that has now been enacted in Finance Act 2025. So just to confirm that's happened. Right. Second tax case to look at, the executors of Elborn and others. And this is a really quite an important case, and it's a bit unusual in a way. I wouldn't normally talk about avoidance cases, and that's exactly what this is. But it's my understanding, it's been widely reported that very, very large numbers of people took up this scheme in the early 2000s before some rules were changed. So people haven't been doing it since I think it's about 2003-4 onwards. But this is inheritance tax planning, of course. So lots of people have done it and are now, if you like, in some kind of limbo. Because HMRC thinks that these home loan and double trust schemes do not work. The whole intention of these schemes was to take the value of your home out of the estate and to avoid gift with reservation provisions where you carried on living with it. And HMRC were clearly confident they were going to win these cases because they have guidance in the inheritance tax manual on how you can unwind these arrangements or how you can reach a settlement with HMRC. And so Mrs. Elborn had used one of these schemes, and she sold her property to a settlor interest in possession trust in return for a loan note. The loan note was gifted to a second trust from which she could not benefit, but obviously members of her family could. She survived 7 years from the gift, and obviously the intention behind the scheme was that the loan note would be deducted on death, thus removing the large amount of the value of the property from her estate. So HMRC challenged it, and the first tier tribunal found in favour of HMRC, but only on one of its 11 different arguments. And they found that the loan note had been created by Mrs. Elborn, so it simply wasn't deductible, so the scheme didn't work. The executors appealed, and HMRC cross-appealed on 5 other issues. And the upper tier tribunal has now found in favour of the executors. But I'm going to put a couple of caveats on that. Firstly, there are a lot of these schemes, and I gather there are different variants. So I suppose it's just possible that while at the moment the UTT thinks it works as far as Mrs. Elborn's concerned, it might not apply to all of the variants. And secondly, and I think this is pretty certain, it seems inevitable really that HMRC will appeal. Now we don't know that for definite, but I certainly would expect they would, simply because of the number of cases. So I thought it was definitely worth a mention, because I've been asked about this at the first tier tribunal stage, and I've already had a query about it at the upper tier stage. And one thing I have done, there is a meeting of HMRC's Capital Taxes Forum in May, and I have asked them if they're intending to update the guidance in view of this decision. And we're waiting to see what they plan to do. And it may depend, as say, whether they appeal, although I'm certainly expecting that they will appeal. So I thought it was worth a mention in case, because I suspect some of you may well have clients, you know, who've talked about this to you. Right, this is another bit of a confirmation. The changes to the non-domicile rules have now been legislated in Finance Act 2025, which received royal assent earlier this year. This abolishes the remittance basis of taxation for non-doms from 6th of April 25. There's a new 4-year foreign income and gains regime for new arrivals to the UK. So that's people who have not had. Let's put this again. If you've had 10 consecutive years of non-residence, that will make you a new arriver in the UK. And for 4 years, you can bring in all this foreign income and gains and it won't be taxed. So that's pretty generous incentive to come. If you don't qualify for that because you've been here a while, you've been using the remittance basis, you may qualify for the temporary repatriation facility. So that's 3 years when you can bring some of this unremitted pre-April 2025 foreign income and gains into the UK, and you'll pay tax at a lower rate. It's 12% for 25/6 and 26/7 and 15% for 27/8. Very important, obviously, to go and look at all the detailed rules and conditions for all of this. You might also qualify for the rebasing of foreign chargeable assets to their market value at 5th of April 2017, where the disposal occurs on or after 6th of April 2025. And just also worth a mention, we knew that the new residence-based regime for inheritance tax was coming in from 6th of April 25, and it has. So inheritance tax will no longer depend on domicile. It's dependent on whether you're a long-term resident. One thing that's really important was back when this was first announced, it looks as though people who had been here for a while and then left were going to have a 10-year tail. So for 10 years, their offshore assets would remain within the scope of UK inheritance tax. Now, that has in fact changed. If you go and have a look at the Finance Act, you'll see that there's a little table which shows you that if you've got 13 years or less residence in the UK, 13 years or less residence in the UK, the tail will only be 3 years. 14 years, it's 4 years. 15 years, it's 5, and so on, up to 20 years, where the tail will be 10 years. So that's a bit of an adjustment to, I think, try and persuade, stop some non-domicile people, formerly non-domicile people, leaving. Okay, right, business taxes. And again, this is a big no change. We've still got the CT main rate at 25%. We've still got small profits rate of 19%, where you've companies with profits of 50,000 or less. And if you're a company with profits between 50,000 and 250,000, then you pay tax at the main rate reduced by marginal relief. None of that's changed. Full expensing made permanent by the previous government, and obviously, as I said before, permanent is only permanent until the Chancellor decides it's not. But for now, full expensing continues. But what we haven't heard any more about is this government commitment to look at extending full expensing to assets bought for leasing or hiring. We've had nothing on that. And there was a little working group looking at this, and that hasn't met recently. So I'm not quite sure we just don't know whether that's still being considered or not. There are lots of concerns, particularly from HMRC, about scope for avoidance. So watch this space. AIA is still $1 million. And just to remind you, this has now been legislated in Finance Act 25. They did extend the first year allowances for qualifying expenditure on zero emission cars and electric vehicle charging points. So if that's something business is planning to do, definitely worth keeping an eye on that deadline. Right, I'm just going to give you an update. The corporate tax roadmap was published on Budget Day last year, sets out lots of things, including various pledges on the rates and AIA, all of which I've just gone through. But we were promised a whole series of consultations, so I'm just going to give you a bit of an update on this, and I'm going to talk about 1 or 2 of them later. Tax development pre-development costs, that's currently on hold, and I'm going to come back to that in a minute to explain why it's on hold. A new process that will give investors in major projects increased advance certainty. I'm going to talk about that later. And I'm also going to talk about clearances in R&D reliefs later. Two that came out on Monday, and I'm just bringing them to your attention here. I'm not going to talk about them today because they're obviously fairly huge, but they are there. This is a consultation, a second consultation, there's already been one, on reforms to permanent establishments, diverted profits tax to bring it within corporation tax, and simplifying transfer pricing, including probably removing UK to UK transfer pricing. That consultation is now available, closes on 7th of July. And we have this other consultation. Now, the headline from this one is that it's proposing to remove the exemption from transfer pricing for medium-sized enterprises. So I imagine that might cause some concern. And there's this requirement for multinationals to report cross-border related party transactions. So obviously that's something to have a look at, but they don't close until 7th of July. Right, this is why the pre-development costs consultation has been put on hold. Some of you may remember this case used to be called Gunfleet Sands, and for some reason it's now called Duddon Sands. This is companies constructing, owning and operating offshore wind farms. One of these wind farms was at Duddon Sands and one of them was at Gunfleet Sands, hence the names of the cases. They incurred expenditure on lots and lots of preliminary studies, which you need to do if you're going to construct wind farms. And what happened was that the first tier tribunal said that they could have capital allowances on some of this, but it was all capital expenditure. The upper tier tribunal confirmed it was capital expenditure, so there was no question of any revenue deduction, but decided that none of it qualified for capital allowances, none of it. And so I gather this is huge amounts of money. I think something like 50 million. So if you were going into a big project like this, thinking you were going to get some form of tax relief, that's quite a problem, shall we say. And that's really why the government was going to have this consultation on pre-development costs. It was directly linked to the upper tier decision in this, which was causing lots of uncertainty and concern amongst potential investors, because businesses like to have certainty before they go and invest in big projects. Now, what's happened is that the Court of Appeal has found that the expenditure was largely on the provision of plant and qualified for capital allowances. So that's why the consultation is currently on hold. But as I said on the other slide, the government's interested in input on that. And again, if you have any views on, putting this on hold, you're welcome to email the tax mailbox, and we have got a route to raise those issues. I think it's important that the Court of Appeal clarified that when you install plant, it's the cost of the plant, but also the installation costs that's provided by statute. But what the Court of Appeal has said is that you can have also expenditure for things like the costs of studies which inform that installation or the design of the plant. So that's quite an important clarification. Now, it remains to be seen whether HMRC appeal. It remains to be seen whether we do get that consultation in future. But as I say, any thoughts on that, do drop an email to the tax mailbox. But that's where we are for now. And that's why, for now, the consultation on pre-development costs is on hold. Right. Really important e-invoicing consultation. This potentially affects all businesses, so really worth having a look at it if you haven't already done so. ICAS will be submitting a response to this very shortly. E-invoicing is the digital exchange of invoices between the buyers and suppliers' financial systems. So one computer to another, it goes straight into your accounting package, no manual processing required. We're slightly behind on this. Lots of other countries already require businesses to use e-invoices for at least some transactions. Some countries, all the invoices have to go through a centralised government system, usually run by the revenue authorities. E-invoices, you can use them in the UK. Some accounting packages do have an e-invoicing section, but the uptake's very low. Not surprising, really, because, of course, why would you take it up if you thought, well, my suppliers won't, I don't know if my suppliers or my customers will accept these invoices. My computer might send them out, but will they be able to receive them? The government thinks that if we did have e-invoicing, it would improve business productivity and cash flow. I think there's a bit of skepticism about that, because if somebody can't pay an invoice, it doesn't really matter whether they've had it electronically or not. And simplify tax reporting, which it certainly might do. because all these invoices would be automatically logged into your accounting systems. There's a joint consultation, HMRC and Department for Business and Trade, which is consulting on promoting e-invoicing across UK businesses and the public sector. Obviously, if you deal with, ordinary consumers, you won't be e-invoicing them. And that could essentially be a problem if you're a business that has both business customers and non-business customers. Because if you've got lots of non-business customers, you then have to possibly maintain two invoicing systems. There are some questions like, should it be a centralised model, i.e. everything going through HMRC? It has to be said the consultation is not favouring that, although there is a question about it, or a decentralised model where it's simply done through everybody's software. Although if it's a decentralised model, there is a suggestion that there should be a feed that then goes to HMRC afterwards, but obviously doesn't stop the invoice actually being issued. Should it be mandatory or voluntary, or mandatory above a threshold? I think if it stays voluntary, then the take-up probably stays very low. Although one thing that might encourage take-up is that they are talking about introducing a common standard so that all these different e-invoicing systems would talk to each other, because that would obviously be absolutely essential. So in the same way as if you've got an Apple iPhone that can talk to a Samsung Galaxy phone, your e-invoicing system from one software provider would be able to talk to your e-invoicing system to another, because they would all have to meet a common standard. How long would it take for businesses to implement e-invoicing? And now we've had feedback from large businesses that they'd need at least 2 years if they were doing it from scratch. Some of them, of course, may use e-invoicing already, particularly if they're doing it overseas. We had a discussion with the HMRC consultation lead, and that was with members of the Indirect Taxes Committee, because I've put this in the business section of this presentation because I think it's much wider than just your VAT department, but obviously because of the involvement of invoices and the importance of VAT, lots of VAT departments might well be leading on this. So we had a meeting with our Indirect Taxes Committee and some people, somebody from our Owner Managed Business Taxes Committee, and we've also had feedback from the OMB Taxes Committee. We're submitting a written response, but there's still time for businesses to give input via the online form. So I certainly encourage you to do so if you've got views on any of that. It closes on the 7th of May, so you've got about a week to do it. So definitely worth having a look at that. There are 2 further consultations on clearances, which we would very much like any input you have on. Again, send it to the tax mailbox. Advanced tax certainty for major projects closes on 17th of June. I've posted an article on the website which sets out the proposals, but essentially this is a dedicated service for large and innovative projects, and this is to give prospective investors certainty about the tax treatment, particularly for corporation tax, although the consultation asks about whether other taxes should be included in there or not. It will provide certainty on how those tax rules will be applied to a project if the project goes ahead as set out in the application, and you might have to pay for one of these clearances. It's only going to apply to dozens of projects a year and hundreds of millions of expenditure. So you might think, well, this is not really of any general great interest, but what they are also proposing is to publish summarised anonymised clearances, which might well be useful to lots of other people. So it could be something that's quite useful. It's certainly new, and obviously the government wants views on how it should be structured, what might be most likely to encourage investment. And I say, if you have any views on that, do drop us an email. The other one is clearances for R&D tax relief. Now, this one's slightly different because the first one would all be entirely voluntary. But here, the consultation is looking at voluntary and mandatory assurance. And that's because of the levels of fraud and error that HMRC has been encountering with R&D tax relief claims. And the voluntary ones, and again, potentially you'd have to pay a fee for this. That's one of the consultation questions. This might be aimed at growing companies or companies with future potential. The mandatory ones would be, you'd be required to go and get a clearance if there were claims in certain areas with a higher risk of non-compliance. So that might be certain sectors where it's highly unlikely that there would be any R&D, like care homes, for example. And there were three possible stages when you could get this clearance: pre-activity, pre-claim and pre-payment, and the consultation wants views on which would be useful. And there's also a question, should a minimum expenditure threshold be introduced to reduce the number of claims? Because unfortunately, a lot of the error and fraud is in some of the lower value claims. And of course, it's very difficult for HMRC to go in and check them all because of the volume. So that's another question. So obviously, again, if you get involved with R&D relief, that's worth having a look at. We've had a brief discussion with HMRC about this already, and we may be having another discussion. So again, any thoughts, drop an email to the tax mailbox. Right, VAT. I expect you're getting used to this by now. This hasn't changed. The VAT threshold increased to 90,000 from 1st of April 2024. It had been frozen at 85 since 2017 before that. It's not changing. And the deregistration threshold was also increased last year, but it's not changing. We had VAT on private school fees. I talked about this in the autumn presentation, and it came in from 1st of January 25. I imagine most of the work on that has obviously been done, and private schools will now be starting to file their VAT returns. Just to note, though, that we did give quite a bit of input for HMRC's guidance, and we gave some comments on the draft. And it was very disappointing when it was first issued, because I think they had to get it out in a hurry, so it wasn't very long. It didn't cover very much. It has been updated and expanded since then. So if you looked at it and didn't think it was very useful, and you've now got a question, is worth having another look. There is a legal challenge to this entire policy, which I'm sure you've seen reported in the press. There's no outcome to that as yet. I just wanted to highlight this because since Grenfell Tower, there's obviously been lots of focus on the treatment of cladding remediation and the VAT treatment. HMRC has been taking a very hard line on this, and we've been pushing since 2019 when they were discussing this with several VAT stakeholder forums. But they weren't putting it in the public domain. So we've been pushing them to put something in the public domain, and we now have it. There's a Revenue and Customs brief, and there's also a guidelines for compliance. I'll say something about GFCs a bit later on. Just for now, just to accept that it's HMRC guidance. And there's two of those. So both of those deal with HMRC's position on VAT and cladding. It has to be said that I know some queries were taken to a meeting of one of the VAT forums earlier this year, and that I don't know whether there will be any changes as a result, because there were some questions raised. But at the moment, at least we do have something in the public domain if that comes up. I just want to mention a really important principle here. It's a tax case, as you can see. Eurolaser IT Limited, they bought and sold IT equipment. Single director, Mr. P, he'd been doing this for over 30 years. He had 6 or 7 employed and self-employed traders, including a Mr. D, who joined him, I think it was the beginning of 2018. He was actually self-employed, but along with the employees, he worked for Eurolaser, and they all sat in an office with Mr. P, who took all the big decisions. And HMRC issued some assessments to recover underdeclared output tax, to charge underdeclared output VAT and to recover input VAT for various periods in 2018. And these principles were issued in line with the EU case law in MEXEC for output tax and KITL for input tax. And the really key point here is that those assessments were issued on the basis that E Limited knew or should have known that it was participating in chains of supply involving fraudulent defaulters. And so obviously, because those are fraudulent defaulters, if HMRC doesn't issue the assessment, they won't get the VAT. And the knowledge, the reason that E Limited knew or should have known was because Mr. D knew. That was HMRC's argument. And I think it's worth noting here that unbeknownst to Mr. P, because he didn't carry out any due diligence when he took on Mr. D, he didn't check any references, and he didn't do any basic checks on Mr. D, because if he had, he would have found that Mr. D had been disqualified as a director. And one of the reasons he'd been disqualified was that one of the firms, one of his own companies, had already been at the tribunal before, because he had been involved in these fraudulent supply chains before. And it's rather noticeable that all of HMRC's assessments related to transactions put in place by Mr. D, and some of them were pretty odd, back to back, same day and all this. So the first tier tribunal upheld the assessments and penalties on Eurolaser Limited, over £1 million. And they highlighted two key features, one of which was that HMRC had actually alerted Mr. P in 2017 to the fact that he was trading in an area that was very open to these fraudulent defaulters. Unfortunately, supplies of IT equipment, mobile phone, anything like that, very, very open to this kind of fraud. And so they had warned him. And secondly, he hadn't done any checks on Mr. D. So I really wanted to mention this case because it's so important that people do their due diligence. They need to check the people they're trading with, and they need to check up on employees, or in this case, somebody self-employed that he was using. Now, we don't know if it will go to appeal, but obviously I call this an awful warning case. It's something to be aware of and to make sure that those checks are in place, because the cost has fallen on the company. Right. I mentioned GFCs. I really want to flag this one. I will talk about GFCs more generally in a minute. It's just an HMRC guidance product, basically. This one, GFC 8, is really likely to be helpful for most VAT registered businesses. So it could be any VAT registered business would find this helpful, because it sets out what HMRC thinks of as good practice related to VAT accounting, compliance processes. Not all of it will be relevant to every business. You pick and choose the bits that are relevant. The second part of it, which is the approach to VAT compliance controls, gives a sort of really good idea of what HMRC expects. And this includes things like risk management, identifying, evaluating risks, the appropriate controls to reduce those risks, designing and assessing controls, documenting them, documenting the roles of people and what happens, contingency if somebody's not around. And there are a whole lot of other sections. So if you've got clients who are, registered for VAT, but maybe having a bit of problem with their, with their processes, it's really worth having a look at this. If you run a business yourself, it's really worth having a look. Now, clearly, none of this is mandatory. This is HMRC being helpful. And it's could just help you to see what it is that HMRC might be looking for if they came and did a VAT check, or if they opened an investigation. So it's really worthwhile having a look at this. Some good stuff in there, and I know that quite a few of the big four have been running their own webinars on this. They think it's so good, so definitely worth having a look at that. This was published on Monday, an announcement about the capital goods scheme, which is going to be simplified. We don't have a date yet. It's dependent on when they get the secondary legislation out. They're going to remove computers from the assets covered by the scheme, which I mean is long overdue. As I'm sure if you deal with this, you will realise been pointless having them in there for years. They're also going to increase the capital expenditure value of land, buildings and civil engineering work, which is currently 250,000, which of course is ridiculously low, and is going to increase to 600,000. I know some people would have liked it to increase more than that, but at least it's going up, and that will obviously reduce the administrative burden on businesses. There's a consultation on the VAT treatment of business donations of goods to charities. This should be really, really helpful for any business that wants to donate goods, because at the moment you do get VAT relief if you're a business and you donate goods to the charity for sale, which would usually be through their charity shop. And so in those cases, you get a 0 rate on the supply and you can recover the input VAT. But you don't get that relief if you donate goods to a charity, either for onward donation, so the charity is going to give them to somebody else, or if you give them something for the delivery of the charity's services. You might give them a computer or something to help them deliver their services, but you don't then get all the VAT reliefs. And that's because there's a greater risk of fraud there, particularly diverting the assets to a connected person or something like that. So this consultation is looking at how can we change this without leaving it open to fraud? How can we let you have the VAT relief where you donate these business donates these goods to a charity? And they want information on all those things that I've just put on the slide. So what models do businesses and charities use? What should be the scope? Should we have, say, a cap on the amounts, £100, more than that? There's all sorts of questions. And also how would we design the administration so that we can prevent fraud, but also so that it's not too difficult for everybody to use. So really interesting consultation, and we've been waiting for that for some time, and I keep being asked when it's going to appear, and it finally has. Raising standards in the tax advice market. This is just an update. I have a sort of long running slot for every session on this, and there's still no decision on whether there's going to be a tax regulatory framework. You may remember there was a big consultation on that in 2024. ICAS and the other main professional bodies supported option 1, which was to mandate that everybody who gives tax advice must belong to a professional body. We don't have a decision on that. We do know that all tax practitioners that interact with HMRC on behalf of clients will need to register with HMRC from April 2026. And obviously HMRC will then check certain basic things like money laundering supervision. We're expecting a technical consultation on the mechanics of that in summer 2025. So watch out for that, because if you're an agent, you will need to register. And there is some question mark over what happens to agents who are already registered and how that's transitioned. There's a new consultation, closes on the 7th of May, enhancing HMRC's powers, tackling tax advisors facilitating non-compliance. I think what this does is it will give HMRC hugely increased powers and the ability to impose increased penalties on tax advisors who facilitate non-compliance. Now, that would all be absolutely fine if this was properly targeted and it was going to affect, say, the rogue R&D advisors who just put in claims that have no basis at all, in fact, and are just not correct. Unfortunately, the way it's proposed at the moment, it could potentially affect an advisor who submitted one incorrect return. Now, one assumes HMRC wouldn't use it like that, but unfortunately, that's how the proposals appear at the moment. So I think there are some concerns about the targeting of it, and we will be submitting a written response. The final bullet we do support. This is HMRC disclosures to professional bodies where there are problems with their members. At the moment, that they do that very, very rarely. They can already do it, but they do it so rarely because they would only do it where it's crossed the threshold for disciplinary action. And what they're proposing to do is to be able to disclose to professional bodies where, for example, it looks as though a member hasn't got the appropriate expertise, is making lots of mistakes, and the professional body then might be able to help the member. So it closes on the 7th of May. Again, this has an online form if you want to put in your own views, and we have already had meetings with HMRC and we will be submitting a response. So finally, I promised you that I would talk about guidelines for compliance, and so I'm just going to say to you, HMRC's been issuing this new guidance product since 2022. Some people think that they're only for large businesses because they arose as a result of a review HMRC did of large businesses, but that isn't true. They're useful to businesses of all sizes and to agents. There are 12 of them with more in development. They cover a range of taxes. They're all on the website. I've posted an article recently which lists them all and tells you a bit about them, so do go and have a look at it. They're really good. Like as with the VAT one that we went through in some detail earlier, they give you HMRC's view, highlight common problems that might lead to errors, so you might be able to avoid, say, an HMRC intervention, and they suggest practical approaches to lowering risk. And there's just a few examples on the slide, but if you go and have a look online at my article, they're all listed there, and there's a link to where they are on HMRC's website. So they're really worth having a look at if you haven't already discovered them. There are a couple of other open consultations. This one only appeared on Monday. This is looking at how we can improve ADR, that's alternative dispute resolution, and statutory review, try and stop cases going to the tribunal. Reform of behavioural penalties closes on the 18th of June. My colleague Chris has put an article up on the ICAS website setting out the proposals and asking for input by the 9th of May. There's also one on closing in on promoters of tax avoidance, which I wouldn't normally mention because obviously members of ICAS who adhere to PCRT are not likely to be promoting marketed tax avoidance. But there's another problem with this one, as with the one I mentioned earlier, in that the scope is extremely wide. And one of the suggestions is that DOTAS will be extended to include a new hallmark for disguised remuneration. And if you don't make a disclosure under DOTAS, there's a proposal for a strict liability criminal offence. But there has been a suggestion that this might apply, because of the way it's written at the moment, to cases where, for example, directors take a small salary and then pay themselves large dividends. So I think that's the concern again here, is targeting, because particularly if you've got a strict liability offence coming into play. So might be worth having a look at. And we have an outcome to the consultation on new ways to tackle non-compliance, which I talked about in last year's session. HMRC are now going to look further at reforming revenue correction notices, approaches to taxpayer self-correction, and they're going to look at some longer term work on developing and harmonising powers across the regimes. So that's just something to note, and they're not taking forward the proposal for partial inquiry powers. And that brings us really to the end, but I just want to make a mention to you. I have already said today about several areas where the tax team raises issues reported to us by members through HMRC stakeholder groups. That includes things like problems with systems. We took up a problem with the VAT forms, VAT 50 and 51 forms earlier this year, which then got fixed. We also give input on policy and technical issues, and I've mentioned some of those. We are also members of the Charter Stakeholder Group, and every year the Stakeholder Group does a report on HMRC's performance, which gets published in the annual report in July 20. It came out in July 2024 last year. I'm expecting it to be around the same time this year. And that survey for members to give us input is currently open. It closes tomorrow. So please do leave this webinar, go to the website and fill it in. It's an article by me on the website. Do fill in that survey, because that will get reflected in the report. And we do joint letters and meetings with ministers and senior officials, which I will not read out to you what the latest examples on the slide. And I promised you that the webinar, the tax email address would appear, so it's there. Send your any feedback on anything that I've mentioned today or anything else to the tax mailbox. And do tell us about any problems you're seeing. Do fill in the Charter Stakeholder Group survey. And if you're interested in joining an ICAS tax committee, do look out for any advertised vacancies. They all appear on the ICAS website. Thank you very much for attending. Hope you enjoyed it. Hope you found it useful, and see you next time.
Susan, thank you so much. That was a really fully comprehensive update there. So once again, thank you very much for that. As we do draw this webinar to a close, it'd be great if you could leave us some feedback for today's webinar. There'll be a poll that should appear either on your screens or in the chat box, depending upon how you're joining it. But we do really appreciate your feedback, so do please take a few moments to respond. And please remember that you can keep up to date with all the latest tax and other professional news, including the latest information, guide and resources on ICAS.com. And of course, the technical help desk is there as well if you want to submit any questions through that as well. So just finally, just having a quick look ahead, we do have a range of events in the weeks ahead for which you can sign up to. As has already been mentioned, you can join us in 2 weeks' time on Thursday the 14th of May for the second of the Spring Tax Update series, when Chris Campbell and Justin Ricomini will join me to examine developments in OMB and employment taxes. And then the week after that, on the 22nd of May, we'll be joined by a range of speakers to explore the new Charities SORP 2026. And please don't forget that on the 11th of June in Glasgow, we'll be hosting our annual practice conference, where we'll explore how you can thrive in 2025 through a focus of 3 key themes of people, process and technology. And during this full day in-person event, you'll hear from a really exciting range of speakers as we lead you through sessions and workshops that will allow you to focus on the direction of your firm with some real practical takeaways and ways to build value for your firm. So links for all of those events are available in the events section of ICAS.com. It does now only leave me to thank you, the audience, for joining us in the webinar today. I hope that the webinar has been helpful to you, and thank you until the next time. Goodbye.